Hey, what's going on, guys? This is Marcus Demitri with Minority Wall Street. Simply put, we're here to increase your investment mindset. We believe that once you have it, you own it. Profits over everything. In this video, we're going to discuss something that's very near and dear to our hearts: options. Options. God, I love options. Yes, we're gonna talk about options. If you not know, but you kind of should know that Anonymous J and myself, we are options traders. We've been trading options quite some time, and we have established, some financial independence, as well as able to, generate wealth, not just for ourselves but for our families. And we want to share this knowledge and our experiences with you guys. So we created a series called "We Got Options." It's a series that's going to be laying out the foundations and the basis of options and options trading to the advanced side of options and learning how to trade and being a part of the investment trading community when it comes to options. So, hope you enjoyed this video. Please comment, like, subscribe, whatever you got to do. Share this video. This is free knowledge, so we don't believe in charging for free knowledge, So we want to build a community up with other like-minded individuals. So we're going to dub you guys the Minority Wall Street team. So that's who you guys are to us, our Minority Wall Street team. So we're gonna look to get this money. We're gonna look to generate some wealth and have fun in the process. So on to the video.
When I come around, got the whole thing wobbin', wobbin', wobbin'. When I come around, got the whole thing wobbin'.
All right, let's go over some option terminology. So I have an option description. You have X, Y, and Z company, which is your asset. It's the underlying security. So typically in the option format, you will see the underlying security first, which is the asset. The expiration date you will see right after the asset, which in this example is May 15th. This is the date and time that an option no longer exists. So remember, options are a wasting asset. They have a limited lifespan. So it's not that you can hold an option forever. You have a certain date and a certain time for that option to expire. The strike price is the price at which the underlying security will be delivered in the event the option is exercised. So if, say, for example, you have a call, which will explain the strategy later. You have a call at a strike price at 100, and the value increased to $105. You're able to purchase that contract at 100 while the stock is actually 105. So you actually will profit $5. The option type, this letter is either a C or P, which indicates the strategy, whether it's a call or a put, which we will discuss later in the presentation. And the premium price is the price at which an option can be bought or sold. What is an option? Options are financial instruments that are derivatives based on the value of an underlying asset, such as stocks, currencies, ETFs, bonds, and or commodities. An options contract gives you the right, but not the obligation, to buy or sell an underlying asset at a set price on or before a certain date. And you're probably thinking to yourself, what is he talking about? Let me give you an example. You see a house that you want to buy that costs you $200,000. Unfortunately, you don't have $200,000 in cash to purchase the house. So you go to your local bank and draw up a contract, which has terms and agreements in order for you to purchase this house at a set price of $200,000 on or before a certain date. Typically, it'll be 30 years. So you go into this contract knowing that you're going to buy the house, meaning that you're going to meet the terms and the obligation. You're going to exercise the contract by fulfilling, again, its terms and agreements. And after 30 years of paying $1,000 per month, you have the house. Or you think to yourself, I don't want to keep this house. I'm in year 10. The house is worth more than what I originally drew up my contract for. So I have the right to sell the house at a higher price. That's the same thing with options. It's contracts that you can buy from a low price and sell from a high price, or you can buy the contract and have it exercised to where you might have ownership of that underlying asset. As a disclaimer, an option does not represent ownership in the asset because it's a contract. It represents the potential for ownership, but it must be exercised to make that happen. The playing field. There are two types of options. A call option, meaning that it's a bull market, prices are going up. Put option, which is considered a bear market, meaning that prices are going down. A call option gives you the right, but not the obligation to buy a stock at a specific time period. A put option gives you the right, but not the obligation to sell a stock. Buying a call option is bullish, meaning you think the stock is going up. Buying a put option is bearish, meaning you think the stock is going down. As a disclaimer, one option contract is the equivalence of 100 shares. When to use a call option. Let's say you are bullish on a stock, meaning that you think the stock is going to appreciate in value. The stock price of Demitri Co. is currently trading at $100. You buy a call option with the premium being $3.15 for a July 105 call, which indicates that the expiration is the third Friday of July and the strike price is $105. Since each contract represents 100 shares of stock, the total cost for one call option contract is $315. That's $3.15 times 100 shares. Guess what? What's way? 2 weeks later, the stock price appreciates to $115. So now your option contract is now worth $10.26. And now you decide to sell your option contract to lock in your profit. It's time to get to the money. You can immediately sell your contract at the market value before the expiration date. $10.26, which is your new value, minus $3.15, which is your initial cost, equals to a profit of $7.11. But don't forget, if you times that by 100 shares, because again, you bought one option contract, your total net profit is $711. When to use a put option. Let's say you are bearish on a stock, meaning you believe the stock price is going down. The stock price of Anonymous J Core company is trading at $45. You buy a put option with the premium being $1.15 for a May 40 put, which indicates that the expiration is the third Friday of May and the strike price is $40. Since each contract represents 100 shares of stock, the total cost for one put option contract is $115. That's $1.15 times 100 shares. Guess what? What's way? 3 days later, the stock price is trading at $30. So now your option contract is now worth $9.26. And now you decided to sell your option contract to lock in your profit. It's time to get to the money. You can immediately sell your contract at the market value before the expiration date. That's $9.26, which is your new value, minus $1.15, which is your initial cost, gives you a net profit of $8.11. And if you times that by 100 shares, because one contract equals 100 shares, That gives you with $811. Other times, you can buy a put to protect your asset. Let's say you're bullish on the stock again. The stock price of Minority Street Company is currently trading at $40. You physically buy 100 shares at $40 per share. That's $40 per share times 100 shares, which gives you your initial cost of $4,000. Despite your bullish outlook, you want to protect yourself in case price declines. You buy a put option with the premium being $2.75 for a February 36 put, which indicates that the expiration is the third Friday of February and the strike price is $36. Your original investment of $4,000, which you are physically buying shares, plus the cost of the put, gives you the total cost of $4,275 for a long stock position and a long put option. The stock declines from $40 to $30 per share. You exercise the put and sell the 100 shares of stock you own at $36 per share, instead of the market value being at $30. By ensuring your long stock position with a put, you only lost $675 instead of $1,000. Let's see the math. With a put, your original investment is $4,000 minus the cost of the exercise put plus the amount sold per 100 shares of the new value of $36, which gives you a loss of $675. So if you did not have a put, your original investment would have been $4,000 plus what the current stock is trading as is at $30. So your loss would be $1,000. So you see how buying that put, buying that particular insurance on your asset saves you money in the long run in the event that the trade goes against you. Let me give you another example. If the stock had gone up to $50, meeting your bullish expectations, you would sell shares for $5,000. So your original investment would have been $4,000 plus the $5,000, which is the amount sold per 100 shares, which is $50 times 100 is $5,000, minus the cost of the unexercised put. You didn't have to exercise the put because the price went up in value. So your total gain is $800. So this diagram right here kind of breaks down the difference of going long and going short. Going long, as far as buying a call, you have the right to buy the stock, which is the bullish sentiment. If you long and you want to buy the put, you have the right to sell a stock, which is the bearish sentiment. If you short the call, meaning sell the call, you're obligated to sell the stock, which is a bearish sentiment. If you short or sell the put, you're obligated to buy the stock. It's the bullish sentiment. So these are strategies that you can make regardless if the stock is going up or is going down. But for this particular training in the video, we're going to primarily focus on the buy side of options. Some smart investor tips. Remember, options are a wasting asset with a limited lifespan. You have to be active. The main advantage is that options allow you to control 100 shares of stock without having to buy those shares. Option strategies range from high risk to extremely conservative, just like any type of investment. So you'll hear some people say, well, options is way too risky for me. Well, hell, investing is risky in itself. But if you understand risk management, you'll know how to tailor and minimize your risk in order to make gains. Option traders like you can profit whether the market rises or falls. The trick is knowing ahead of time which direction the market would take. Hence, you got to understand your technical analysis. And that's something that we'll get into another training. Once you buy an options contract, there are 3 different things you can do with it. You can exercise it, you can sell it before the expiration date, or you can just let it expire worthless. Remember, don't chase the market. Don't chase the market. The market is not going anywhere. The market is going to be going up. You don't have to rush to get into it. It's always going to be there. There's always going to be a marketplace. And you understand what's going on in today's times. The market is what primarily everyone is focused on. So don't chase it. Let the money come to you. Don't chase the money. So with that being said, I do appreciate you listening to this quick little video on options. This is part 1. Part 2 will be coming out very shortly, where we'll be discussing more so of the option formula, the risk management of options with the Greeks, as well as in-depth basic strategies on why you will buy a particular call versus a particular put. All right, until next time, peace.
When I come around, got the whole thing wobbin', wobbin'.